Hello and welcome to this new reading in fixed income, Introduction to Fixed Income Valuation. It is really important that you have your calculators, the TI calculators with you, so that you are able to be more into this reading with me. There are a lot of calculations that will take place during the course of this video lectures and the video series for this reading. Lot of calculations are there, and this is actually a really calculation intensive reading. Out of 12 questions each, I predict that around 5 questions will definitely be from this particular reading. Also, not just from a testability perspective, going ahead into level 2 and level 3, this is the basics of valuation for derivatives, for fixed income, okay, asset allocation going ahead in level 3. All this really needs to be taken care of very properly. These are the learning outcome requirements. The value or price of a bond is computed as the present value of the expected future cash flows from the bond. For a plain vanilla fixed rate bond, the cash flows are composed of a periodic coupon interest payment and principal repayment at maturity. The discount rate used to compute the present value of those cash flows is the market discount rate, also known as the required rate of return, which represents the rate of return required by investors to compensate them for the perceived riskiness of the bond. We'll now work with an example which illustrates a couple of scenarios, to be specific 3 scenarios in which the valuation of plain vanilla interest rate bonds would really be clear in front of you. So the first scenario, we'll assume that the market discount rate of the bond illustrated above is the coupon rate offered, that is 10%. Before going into technicalities, the first video of fixed income highlighted the difference between the bonds issued at a discount and the bonds issued at a premium. I highlighted the couple of important features for a bond where I said the coupon rate is only used in bond valuation for one reason, and that is to calculate the coupon amount. The discounting of the fixed income coupons and the cash flows are used with the help of the market rate or the required rate of return. This rate represents the opportunity cost and available return avenues in terms of other aspects and other investment opportunities. Therefore, if a coupon is offering 6%, if a bond is offering 6% coupon interest, okay, coupon rate, and other bonds in the market, similar bonds in the market, okay, are offering 8%, then in order to get that 8%, you need to buy the bond at a discount. On the other hand, if this bond is offering 6% and other bonds in the market are just offering 4%, it means that you are getting something extra, and for that something extra you need to pay an extra, and therefore the bond will be priced at a premium. With this little introduction, let's move into scenario 1. Clearly, when the coupon rate and the required rate of return are equal, the value of the bond, or the intrinsic value, or the value at which the bond trades, the price at which the bond is issued, will also be equal to the face value. These are the calculator strokes. Before moving into the calculator strokes, please make sure that you've cleared your calculator in terms of any other previous calculations. If the coupon rate offered on the bond equals to the required rate of return by investors to compensate them for the risk inherent in the instrument, the bond will sell at its par value. Do note that in year 4, the payment by the issuer to the investor includes the final coupon payment, $100 in our example, as well as the $1,000 face value redemption. Now let's tweak the scenario a bit, where we'll change the market rate of discount to 9%. Before moving here, if other bonds are offering 9% and you are getting 10%, intuitively your price of the bond should be higher than the face value. And in terms of an MCQ question, you definitely can strike out couple of options where the Answer is less than 1000. Notice that if the rate of return offered by investor is lower due to lower perceived risk, the value or the price of the bond is higher, 1032.40 in our example versus 1000 in the previous example. If the coupon rate offered on the bond is higher than the required yield, the bond will sell for a premium. Stated differently, the compensation offered to investors, that is the coupon for bearing various risks inherent in the instrument, is higher than the compensation required by investors for purchasing the bond, that is the required yield. Therefore, investors would be willing to purchase the bond at a premium to par. Finally, let's move on to the third and final scenario where the market rate of return is greater than the coupon rate, in our example 11%. And therefore, the value of the bond can be calculated as follows. Notice that if the rate of return required by investors is high, 11 as compared to 10, the value of the price of the bond is lower, 968.98 in our example. If the coupon rate offered on the bond is lower than the required yield, the bond will sell for a discount. Stated differently, the compensation offered to investors for taking on various risks, that's the coupon amount and the face value, is lower than the compensation required by investors for purchasing the bond. Therefore, investors would only be willing to purchase the bond at a discount to par. The prices calculated under the following different scenarios allow us to reach the couple important conclusion. Firstly, the higher the discount rate, the lower is the present value and lower is the value of the fixed income security. This is the basics of discounting and compounding, and I am sure this must be aware to you since primary school levels. Initially also at school levels, when we discounted something, it means we pulled the cash flow or the amount or the number backwards, and when we compounded it, we sent it forward. And therefore, we really need to use that knowledge in terms of here valuing fixed income securities, because those things never change. The basics do remain the basics. Plotting the relationship between the discount rate and the value of a fixed income instrument on the graph results in a convex curve. This curve is known as the price yield profile of a fixed income security. Notice that the increase in the price of the bond from 1000 to 1032, which is a 3.2% increase, if the discount rate decreases by 100 basis points, is greater than the decrease in the price of bond from 1000 to 968, which is a 3.1% decrease if the discount rate increased by 100 basis points. This is a very important conclusion when it comes to bond pricing and is known as the convexity effect. Here, the rise in the bond price because of the fall in the interest rate is higher than the fall. The bond that we worked with so far in the three scenarios has paid out coupon annually. While this is a norm in Europe, most Asian and North American bonds make semi-annual payments. In our example, if there were semi-annual payments, the N would change to 8, the I by Y would change to either 4.5, 5 or 5.5 depending on the particular scenario. We'll now move to yield to maturity. Do notice that the value of the bond in the previous examples, when I talked about semi-annual payments, would be slightly greater than the value of the bonds in the normal scenarios because of the impact of compounding and discounting. Even though the total amount of the coupon will remain same, the more frequent coupon implies a higher present value for the bond. Yield to maturity. If the market price of the bond is known, then given the terms of the bond, the coupon rate, the coupon payment frequency, the I by Y, the maturity, and so on and so forth, we can compute the yield to maturity as well. This yield to maturity is also known as the redemption yield or the yield to redemption. The YTM is the uniform interest rate that equates the sum of the present value of the bond's future cash flows to its current price. It also represents the internal rate of return on the bond's cash flow given three critical assumptions. Firstly, the investor will hold the bond till maturity. Secondly, the issuer makes timely payments of the coupon, the promised amounts. and the investor is able to reinvest all the proceeds that he get at the YTM until the bond's maturity date. I had already told this, but I'll still repeat because it's important. When calculating the value of a bond using your financial calculator, make sure that PMT and the FV have the same sign, because that is an inflow to you. You'll be getting those amounts, and the PV has the opposite sign. If you invest in a bond, you occur an outflow upfront, but you get back the coupon and the principal. Alternatively, if you issue a bond, you have an inflow upfront, but you pay out coupon and principal. So those are two scenarios, keeping in mind the investor and the issuer respectively. We'll now look at an example to compute the YTM for semi-annual pay coupon bonds. In terms of effort, there is nothing extra needed. There will be 3 or 4 items given to you, and you need to find the fifth item, and that can simply done by a plug and play of the numbers in your financial calculator. Before proceeding ahead, I would want you to solve the question after pausing the video, and then we'll look at the solution together. This calculated yield of 4.58 is the yield per semi-annual period, and therefore the annualized YTM is multiplied by 2 and we get 9.16%. Clearly, the N has increased twice because it's a semi-annual payment, and the coupon has reduced by half because of again semi-annual. Had it been quarterly, this would have been multiplied by 4, and PMT, coupon payments, would have been reduced by 4, and the I by Y needed to be multiplied by 4 to get the annualized YTM. Now let's work with the same example to compute the YTM for annual pay bonds. Pause the video, do the question, and then move ahead. We'll now look at the relationship between bond price and its characteristics. A bond price is inversely related to the discount rate. When the discount rate increases, the price decreases, and when the discount rate decreases, the price increases, and this was clearly illustrated in the 3 scenarios we discussed. Given the same coupon rate and the term to maturity, the percentage price change is greater in terms of the absolute magnitude when the discount rate decreases than when it increases, and this happens because of the convexity effect. For the same N, that is maturity, a lower coupon bond is more sensitive to changes in the discount rate than a higher coupon bond. This is known as the coupon effect. From an exam perspective, you really need to be on top of this slide. Generally speaking, for the same coupon rates, a longer term bond is more sensitive to changes in the market discount rate than a shorter term bond. Note that while the maturity effect always holds for zero coupon bonds and for bonds priced at par or premium to par, it does not always hold for long-term coupon, but not zero coupon bonds that are trading at a discount. We'll look at the relationship between price of a bond of a fixed income security and the maturity. Let's assume how bond's value changes as it comes to near maturity. We'll calculate the value of 1,000 par 4% 10% annual coupon bond, 4-year 10% annual coupon bond, assuming that it was issued at a premium when the market yields were 9%, because market was again giving you 9% and you were getting 10%. Therefore, it has to be issued at a premium, at a discount when it was issued at 11%. So that is the second scenario. This is our first scenario of premium. So we'll be looking at both the scenarios. Clearly, as the time to maturity comes down, the price or the value of the bond falls. It falls from premium to par. Now, if the market rates were 11%, as the maturity nears, the value of the bond increases towards the face value. From these calculations in the table, it is clear that the premium bond's value decreases towards par as it nears maturity. For a discount bond, it increases towards par as it nears maturity, and for par value bonds, the value remains unchanged. We'll now move on to pricing bonds with spot rates. In fact, before this, just a high level point that the constant yield trajectory shows how the price of a premium or a discount bond is pulled towards par as it nears maturity. We'll now move on to pricing bonds with spot rates. Under traditional methods of bond valuation, the expected future cash flows are discounted at a uniform rate to arrive at the value of the bond. This rate is known as the yield to maturity. Arbitrage fee valuation approach does not use the same rate to discount each cash flow but uses the relevant spot rate to discount cash flows that occurs at a different point in time. A spot rate or a zero rate is the yield on a ZCB for a given maturity. For example, the yield on a 5-year ZCB equals to the 5-year spot rate, and it is the rate that is used under the arbitrage free valuation approach to discount the cash flows at year 5. For our purposes, there is no need to get into how spot rates are determined. That is something that you need to do at level 2. Just keep in mind that the yield to maturity discounts each of the bond's expected cash flows at a uniform, that is, yield to maturity rate to determine the value of a bond, while under arbitrage free valuation, the individual discount rate that corresponds to each individual cash flow, that is, each year's spot rate, is used to determine the present value of a particular payment. Therefore, we can say that YTM does a work for all the relevant cash spot rates for a particular sum or for a particular bond. So if for a 3-year bond, the first coupon is discounted at the spot rate 1, the second coupon is discounted at spot rate 2, and the third coupon and principal is discounted at spot rate 3. This happens under arbitrage free valuation approach. However, for us, there is a single rate that will discount all the cash flows, cash flow 1, cash flow 2, and finally the cash flow 3. Therefore, we can say that YTM is a weighted average of the different spot rates. Now, let's look at an example to value bonds using YTMs and spot rates. We will clearly illustrate that YTM is a weighted average of the different spot rates. Do the question and then we'll look at the solution. If we discount each cash flow at the relevant spot rate of 7%, 7.5% and 8%, we arrive at a value of 1001.34. However, the current bond was selling at a yield to maturity of 7.948%, and therefore we still get, if we plug in I by Y as 7.948, we still get the same value, and therefore we can say that YTM is a weighted average of the different spot rates. From an exam perspective, you need to pause the video, do this sum again in order to have a solid understanding and background before moving ahead. We now move on to flat price, accrued interest, and the full price of a bond. When a coupon bond is sold between coupon payment dates, we must account for the interest or coupon that the seller has earned but not yet received. The amount that an investor or buyer should pay for a bond equals to the present value of the future cash flows. But the very next cash flow, the next coupon payment, includes two components. Firstly, interest earned by the buyer and the interest earned by the seller. The interest earned by the seller is known as the accrued interest. It is accrued because it has been accrued from the last payment date till the transaction date. And this timeline illustrates the same. When the price of a bond is determined by calculating the value of a future cash flow as of the settlement date, the computed value is known as the full price or the dirty price or the invoice price of the bond. The price includes accrued interest and reflects the amount that the buyer pays for the seller. From this full price, the accrued interest is deducted to determine the flat price, which is also known as the clean or the quoted price of the bond, as follows. Dealers usually quote flat prices, and then, if a deal is executed, an accrued interest is added to the flat price to determine the full price that must be paid by the buyer to the seller on the settlement date. The reason behind quoting flat price is to avoid misleading investors about the price trend for a bond. Given that the amount of accrued interest on the bond increases each day, full prices rise each day even if the yield to maturity remains constant. Further, full price suddenly drops a coupon payment date when coupon is paid and accrued interest falls to zero. Quoting flat prices avoids such misrepresentation. Also note that it is the flat price that is pulled towards par as the bond approaches maturity. They are clearly expressed the same. The accrued interest is the part of the full price that does not depend on the YTM. Therefore, we can say that it is the flat price that is affected by changes in the market discount rate. The accrued interest is the seller's proportion share of the next coupon payment and is calculated as follows. The legends are as follows. The manner in which the number of days between 2 days is calculated in the bond market depends on the day count convention used in the particular sector of the market. For government bonds, the actual day count convention is usually applied. For example, if the coupon payment dates for a semi-annual pay bond are May 15 and November 15, the accrued interest for settlement on June 27 would actually be calculated as 43, which is the actual number of days from May 15 to 27, divided by 184, which is the actual number of days from May 15 to November 15. And this is multiplied by the coupon payment. However, for corporate bonds, 30 by 360 convention is used. In a similar example, the accrued interest for settlement on June 27 would be calculated as 42 divided by 180 times the coupon payment. When it comes to valuing bonds between coupon dates, you need to understand that as time passes through the coupon period, the price of the bond increases as the next coupon payment draws closer at a rate equal to the discount rate per period. The full price of a fixed rate bond between coupon payment dates can be computed as its value on the last coupon payment date multiplied by 1 plus the periodic discount rate compounded over the period of the time remaining that has elapsed since the last day of the coupon, and is expressed by the following. The legends being as follows. We'll now look at an example that will show us computing the full price, accrued interest, and the flat price of a bond. A 5% US corporate bond is priced for settlement on July 20th, 2015. The bond makes semi-annual coupon payments on April 21st and October each year, and the bond matures after 6 years on October 21st on 2021. The bond uses a 30 to 360 day convention, and we can say that it's a corporate bond. We need to calculate the full price, the accrued interest, and the flat price of a bond for two maturities, 4.7% and 5%. Two yields to maturity actually. So, with the help of the formulas discussed earlier, I would want you to try the solution. Pause the video, try the solution, and then we can move ahead. Given the 30 by 360 day count convention, there are 89 days between the last coupon on April 21st and the settlement date on July 20th. 9 days between April 21 and April 30, and 60 days for the full months of May and June, plus 20 days in July. Therefore, the fraction of the coupon period that has gone equals to 89 by 180. As of the last coupon payment date, there are 6.5 years, that is 13 semi-annual periods. That is 13 semi-annual periods remaining until maturity. From an exam perspective, this is a very likely question. This is nothing but just a plug and play of formulas, and I would want you to look at the solution, the steps that you followed, and what I have done. I have actually produced what is the best and the easiest way of solving the sums in the exam and which is most time effective. Passing professional exams like CFA, CA, FRM, CAIA, and all that is not just about knowledge, it's also about time management, and that can definitely be only managed if you know the best and the most easiest and the least time consuming methods to solve a particular sum. The calculations may sound intimidating, and it definitely is. But if you do not practice these questions couple of times, such variety of questions by taking on random examples, that fear will always remain. Therefore, I suggest to take random examples and do sums. The worst thing that can happen is that you'll be getting weird numbers. So let that occur. You're not here or you're not responsible to get good feel of numbers, right? What if you get 100.00 or 8% exactly? Is that the motive? Is that the motive that you calculate a flat price of exactly $125? That is never the motive, right? The motive is that you really need to understand the concepts, and therefore you can take any random examples and do scratch it behind your copy and then move ahead. So, if you had not tried the second part of the question and were waiting for a guidance, okay, then this is what I have done. I would want you to do the next part yourself. Pause the video, do the next part, and then match a solution. The format obviously will remain the same. The stated annual YTM is 5% or 2.5% for a semi-annual period, and the calculation of the flat price is as follows. Notice here that the flat price of the bond is lower than the par value, despite the fact that the coupon rate and the YTMs are equal. The reason for this is that the accrued interest computation does not consider TVM. Accrued interest is the interest earned by the seller of the bond for the time between the last coupon date and the settlement date. In this case, 1.2361 per 100 of par value. However, do note that this interest income is expected to be received on the next payment date, so theoretically, the true accrued interest should actually be the present value of 1.2361 as of the settlement date. In practice, the calculation of accrued interest neglects time value of money, and therefore reported or computed accrued interest are slightly overstated, which results in a slightly understated flat price. Note that the full price is theoretically accurate as it is calculated as the sum of the present value of the future cash flows as of the settlement date. In order to build a solid understanding, I would want you to try a sum. There, the stated YTM would be 5.3%, therefore, a 2.65% semi annual rate. The answer for the present value of flat price is $98, and that is actually 98.4127. So I repeat, the YTM, annualized YTM is 5.3. So semi-annual would be 2.65 and the flat price is $98.4127. I would want you to try this sum and then move ahead. Notice that the accrued interest is the same in the each case because it does not depend on the yield to maturity. Differences in the flat price captures the differences in rates of return required by investors. We move on to LOSE, which tells us to describe matrix pricing. However, a calculation question cannot come. But in order to solidify our understanding, I have put an example on matrix pricing. Matrix pricing is a method used to estimate the market discount rate and the value of bonds that are not actively traded. Essentially, the prices comparable in terms of maturity, coupon rates, and credit quality are used to interpolate the price of the subject bond. The next example illustrates the application of matrix pricing to compute the required yield and the price of a bond that is not actively traded. This is actually the solution or the explanation of this question. Leave out this O, please. Okay, so this is the explanation. Since there is no formula or as such given, I am doing this solution with you, and then I would want you to pause the video and try the solution yourself. So the first step is to determine the YTM on comparable bonds and is calculated using the following formulas. So we calculated two YTMs. The market discount rate for the 6-year bond can be obtained clearly by linear interpolation of these two rates. The yield on the 6-year bond is estimated as the yield on the 5-year bond plus 1/3 of the difference between the yield of the 5 and the 8-year bonds. It's calculated as follows. Now, given an estimated YTM of 5.28% as calculated here, the price of the illiquid 6-year 5% annual pay bond can be estimated using your calculator and just simple plug and play of formulas. Note, if more than one bond is provided for a given maturity, then first calculate the average YTM for the bonds with that maturity and then apply linear interpolation to estimate the YTM for which a comparable bond does not exist. From an exam perspective, it is very unlikely that such a calculation question can come. For two reasons. Firstly, it's not mentioned in the learning outcome requirement, and secondly, such lengthy calculations are definitely, or I'd say should not be tested on the exam date. There is hardly any space, there is hardly any time to solve a 5-6 minute question. Okay. Matrix pricing can also be used to underwrite new bonds to estimate the YTM spread over the benchmark rate on the bonds to be issued. This spread is the difference between the YTM on the new bond and the benchmark bond. It reflects the additional compensation offered by the issuer to compensate investors for differences in credit risk, liquidity risk, default risk, tax status of the bond that is relative to the benchmark. The benchmark is typically a government bond with a similar term to maturity, and therefore the risks that I talked about are generally not present. Yield spreads and benchmarks are discussed later in this reading. We'll move with an example to understand the application of matrix pricing to estimate the credit spread on a new issue. This is the question. I would want you to go through it and then we'll look at the solution together. Again, it's not an exam testable question, but without this question, on the exam, such numerical directly questions cannot come. But until and unless you understand it numerically, the interpretations will definitely not come. For example, when I started fixed income, I taught something on the board with respect to market rates and the coupon rates. Now I am sure you will really appreciate that if the market rate is greater than the coupon rate, then the bonds are issued at a discount. However, if market rates are less than the coupon rates, then the bonds are issued at a premium. So this understanding is there because not because I have learned these lines. Okay, I do not like to learn things. It's because I randomly generated numbers in my mind and I spoke them out in a fashion that might be tested on the questions. So any concept I try to understand with the help of numericals, and I try to make you understand also, so that your understanding becomes crystal clear and solid. We move on to the solution for the question. The first step here is where we calculate the YTM on the outstanding bonds that have a 4-year maturity, and the answer is 1.85% approximately. Now we'll compute the estimated YTM on a government bond with 4 years maturity using the 3-year and the 5-year bond yields. The estimated yield on the government bond is then used to estimate the credit spread on the company's 4-year bond. The estimated 4-year yield is this, and therefore the estimated spread is the average of this subtracted from this, and therefore we get a spread of 0.65%. Now we'll use the term structure of the credit spreads for issues with a similar rating as the one in question to determine the spread of the 5-year bond the company plans to issue. Therefore, the 5-year bond has the following answer. Finally, we add the expected spread on the planned 5-year issue to the 5-year government bond yield, which is the benchmark to determine the expected market discount rate on the issue. The expected discount rate on the issue is calculated as follows. The term structure of credit spread shows relationships between spreads offered on bonds with a particular credit rating over the risk-free yield of government bonds and terms to maturity. We have already discussed the effective annual rate versus the stated annual rate in a detail in the quantitative methods section. What I am doing here is using the periodicity, that is the number of periods compounded per year of the stated annual rate to determine the effective annual rate. This is all for this part of the reading. I hope you've understood. Please practice all the illustrations and the related blue box examples before you view the next lesson. Thank you.